That's important because we are getting started as we always do right on time because we tend to get out of these things at about 25 after or before. This afternoon, we're covering investment 101s. Well, there is definitely some applicable thing to what goes on in today's market, today being 2025. This is really what we would call the fundamental thinking or the investment philosophy that we think is going to help you succeed and succeed the most often when we look at how do successful people invest. That's one of the key components. There's lots of different ways to build wealth, to maintain wealth, to manage wealth in a stress-free basis, and that's really what we're concentrating on duplicating. I'll have my team come in so you can see their smiling faces. Joel, Wally. All right, gentlemen, you guys look so pretty. Okay, and let's get started. Investment 101. So, what we want you to know about investing. This is the really critical points in terms of like, what are we doing? Here we go. The most important thing that we think in terms of investing is knowledge. I've already alluded to that. But when we think about money, and maybe you can even relate to a story of someone who's inherited a chunk of change. And all of a sudden, a few years later, you notice that their car is not getting replaced, and maybe they're not going on nice vacations. Because although they had a big chunk of money, they actually didn't have the knowledge to manage it. Our team here, the three of us, and then our expanded team, the six of us, really believes that the knowledge has to go across in order to make sure that you're going to have money in future generations. And want to make sure that you're going to have money and be comfortable with the money that you're managing. This is what we really believe in, is that wealth goes across the generations and just takes some of the pressure off. Because if you give people the knowledge, they're going to be able to go out and get it done. This is a much younger picture of yours truly coming up in a second. There we go. I didn't have any more hair. I did notice that, but this is about 10 years old. I didn't have a beard. I didn't, but it wouldn't have had any gray. And what I really struck me about this, and the reason the story is that when you have a plan, you know what you're trying to achieve. We have clients all the time who obviously, when you talk about investments, say, well, can I get more? We just had a client meeting where the client's like, more. And I don't really ever try to talk people out of that, but I do try to take them back and say, more to do what? Like, if you're going to create more and we get a better rate of return and you have more money, where does it actually go? Like, would that help your current cash flow? Does it help your long-term investment? Is it going to help your retirement plan by how much? Does it account for risk and insurance and of course in Canada the taxation, how much you get to keep in your pocket? And then or is it more is it for the next generation? And that's a really important part because especially now the markets have been doing very well for a very long time. And people are always like, well, this is great until a correction happens. And your plan needs to still be able to account for that. So having real solid visions, we're going to talk about that as a thing. And if you just look at your investments, if they're all by themselves, it's not going to work out so well. Remember an 88-year-old client, 88, and I'm trying to talk him down the risk profile. He's 88, but he wants the high octane investments. So over a 3 year period, my very boring conservative investments had done well. It was just one of those periods of time. Short term, you can never tell. But he said his investment returns always made him happy when they were doing well and sad when they weren't because he had separated his investments from his plan. I think that's such a unfortunate story and it's a good lesson for us, a piece of wisdom. Know what you're trying to achieve and then kind of dial in on that one. It also leads me to my favorite thing. You're the biggest risk to your investment plan. You are the biggest risk to your investment plan. I am. This would be a mirror for me. And that is when we react and we think we can figure out what the markets are going to do when they're gyrating like this. We're like, oh, I've got this. True story. Husband and wife, the last 5 years. Wife gets into good investments for them, stays there. Husband has the same investments proposed to him, initially gets in them, and then jumps out. It's too much market risk. Over the last 4 years, ups and downs. You just think about how many events have happened over the last 4 years. And he's in and out and in and out and in and out, and she's just in the same investments. Well, at the end of 4 years, not only had she done ridiculously better, like up to the tune of about 200,000 that he lost by not just sort of staying put. The other piece that was interesting is she hadn't had any of the stress that he had trying to figure out what was going on. When you think about that, when you're in the right risk profile, and Joel's going to talk a little bit about that, one of the common questions that we get. I think when you can sleep comfortably at night, that's the right risk profile. And don't make a lot of changes to your investments unless your goals change. Then that's a really good piece. Again, going back to your plan to say, hey, we need something else. Now, the other thing that we really want to talk about is time horizon. And I'm going to let Wally talk about how he divides dollars and cents. And I've always liked this in terms of the thinking about it. Wally?
Yep. So I moved to Canada about 3 decades ago, and one of the things I had to learn very quickly about money is what I call buckets. The now, the soon, and the later buckets. The reason why this is important is because back at home, my parents had a savings and a checking account. That was about it. Um, they had lots of real estate businesses, but cash, for the most part, ended up in two accounts. They'll put away as much as they felt they needed to pay for everything that they thought they would have to address. Now, moving to Canada, the one thing that I noticed was that you have to put labels on your money. Do you need it now? Would it be soon to buy a house in 3, 4 years? Or would it be part of retirement? When you're clear on what these buckets are, it's easier to determine how what the investment or what you should be investing in. Another way to look at it is short term, medium, and long term. So, for example, your checking and savings account, for the most part, should be short term. Yes, you need money. You need to pay for something at a restaurant, fill up your tank. Medium, am I buying a home in 2 to 3 years? And that decides or determines what the investment should look like. Long term would be RSPs. Yes, there are gray areas in between, but for the most part, when you have these buckets clear in your head, it's much easier to understand. You don't want to be taking money out of Bitcoin to pay for lunch. That's an extreme. And that is a fundamental of that's a big fundamental for me. Interestingly enough, I found out that I was not the only one who was not aware of this. Many people who were born here too did not know this either. And that's why we're talking about it now. With that being said, I will hand over to
Trevor, back to
Trevor.
you. That is, yeah, I wouldn't have had them so eloquently put, Wally. So if shift a little bit, perfect.
Yeah.
Yeah, but the now, soon, and later is beautiful in terms of the thinking of that. When we talk about investments, it really is about how much extra cash do you have. So we did a debt or we did cash flow 101 on just savings, and that's the most important habit. You really can't invest unless there's extra money to put away and put away for something now, soon, or later, right? You need to have extra dollars. So when you're looking at investments, one of the most important things is to say, well, I need to have some dollars. I shared this in that 101, but I'll share it again. My dad's favorite saying is, show me someone who's putting away 10% towards their goals, and I'll show you someone who's going to be fine throughout their life because they're living on 90%. That's still a fundamental part of investments. If all of a sudden, anytime an emergency happens, you have to go into your RSPs or into your long-term investment strategies, it's not going to work for you. And you're going to be disappointed at times in terms of dealing with that. So, really, when you look at it, cash flow is king. Now, when you're doing investments, what do you need to know about how to do rates of return? I think I'm going to have Joel come up and talk about his favorite slide. Joel?
Sure thing. This is what we call the rule of 72, and it talks to compound interest and how long it takes your money to actually double. It was Einstein who said, compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. So, this concept essentially, you take 72, you divide it by your rate of return, and that's how many years it's going to take for your money to double. So, a simple way to think about it, if you're getting a 10% average rate of return, about every 7 years, your money's going to double. And this is very, very important when it comes to longevity and time in the markets, not so much market timing. And I got a little bit of a story that I can translate that into. So when it comes to investment planning and, a story about not panicking and just staying the course, a big one for me was in March of 2020 when COVID happened, the shutdowns. My wife and I were in Phoenix visiting my grandpa, and the lockdown started, and I had tons of people calling me, panicking, and just, really worried about what was going to happen to their money. So a flurry of calls come in, and I was able to convince about 90% of the people that, hey, look, we're in a long-term plan. These things happen. Best thing you can do is nothing at all. And those people who stayed in the market, stuck to their plan, came out well ahead of the people who panicked. And the 10% who did panic not only lost out on the growth that came, that was exceptional growth over the next 8 months, but they also locked in a loss because they panicked. It goes back to that age-old statement of it's time in the markets, it's not market timing. Now we saw this again in 2022. We saw it in April of this year even. And nobody has a crystal ball, but the fundamentals and consistency have proven to succeed time after time.
Thank you, sir. Yeah, as we look at that rule of 72, it really is you need time to let your money duplicate and duplicate again and duplicate again for sure. When we're looking at figuring out where should we be, this is an old slide, but it's still relevant. We pick sectors. Sometimes you see this as different countries that will be displayed. And the reality is, short term, we don't know. It seems very strange that you can make money with an answer like that, but it's a true answer. Short term, we don't know if energy is going to be high, healthcare, consumer staples, materials. We don't know if the US economy is going to outperform China. And so one of the most interesting things, and it was at a fund manager show this past Monday, some very smart people telling about how to generate long-term consistent returns. And they said diversify, and they said diversify, and they said diversify. And I could keep repeating because they repeated that again and again and again. The best long-term strategy has been to hold a piece of each of these areas and then rebalance on an annual basis. And that's what we recommend to clients, and that's what happens within our portfolios and our wrap accounts. They really are designed to make sure that we're not trying to say, we think this is the best sector. And it might be that year. But then if we don't diversify, take some of the profits off the table, then we're just letting it fly for the next year. And what you notice is there's not a lot of repeats at the top of this little jelly bean chart. Nowhere's there when you do countries year over year as well. When you're looking at what to do in terms of the marketplace, once you figured out your time frame, as Wally was saying, as you're thinking about what your investment return, as Joel was saying, diversification is your next best friend and can help you get sleeping comfortably at night. I'll just let you read that. That's saying roughly 500 years old. And I don't know if we're going to hang anybody, but it certainly could be that you're going to end up in prison. And that is what we call them. And we have that euphemism for them. We call them get rich quick schemes, and we don't really trust them. And because they're not really true. If you have an investment that goes up hundreds and hundreds of percent and just going to say, well, it's just going to keep going. Well, I mean, we've heard of Nortel, we've heard of Brexit in this part of our part of the world. Like we know that that's just not right. And yet, if we're diversified and we're patient in our strategy, we know, in fact, that that is going to work out. It's probably the best thing about investing. Know your time frames where you should be going, know how to make compound interest, as Einstein said, work for you, and then realize it's going to take time. It is. It's going to take 20, 25 years, and all of a sudden you start to see the magic of it. And it's hard to convince someone of that when they're first starting. But if you're in your 20s, 30s, or 40s, you still have very much time on your side. If you're in your 60s and 70s, I would like to tell you that life expectancy in Canada is pushing 90. So believe it or not, you also have time on your side, and patience can be a reward for you as well. The whole purpose of the 101 series, which we're proudly to say this wraps it up and we're going to send it as a playlist, is we wanted to cover off what we thought are the fundamentals of a good, solid financial plan. How do we actually create a good financial plan? We look at savings, we cover debt, we cover estate, we cover insurance. You notice we covered investments last because fundamentally, if you want your financial house in order, those other ones trump investments. You have to do it once everything else is in order. All the other ducks are in alignment. And then you know you have a surplus. You know you're protected from risk with insurance. You know things are in the right place. Like that's one of the most critical things when you look at why we would call this the 101 series and the basics. We do have some time for questions and answers, so we're happy to accommodate that. Yes, we're doing good for time. If you'd like to, you can push that in. Two of the most common questions that we have, I'm going to answer one of them, and then Joel's going to answer the other one. One of the most interesting ones that we get right now in 2025 is, isn't the market about as high as it can get? And it was interesting. It was earlier this year that a gentleman shared, hey, 1999, and they pointed the back of their behind him, and it was like the the U.S. stock market was just under 10,000, and it broke 10,000 for the first time 26 years ago, roughly. It was saying. Now, if you said, well, the market can't go any higher, and you pulled out, the market as of today is about 46,000. So you would have missed a roughly 460% increase. What's also interesting about that is do that by the rule of 72. It's just doubled over twice in a little bit. It's actually just over a 6% compound rate of return over the last 26 years. That's interesting as well to know that time and patience, a 6% compound return, is all of a sudden 460% growth for every dollar you had back in 1999. Pretty impressive. The other question that we get a lot of, and I think it's an excellent one, Joel, do you want to talk about risk?
Yeah, absolutely. We get the question a lot, am I in the right portfolio? Am I too risky? Am I not risky enough? And I think it comes back to everyone when the markets are good, everyone's excited and they're like, oh, I can take on all the risk. They think they can take on all the risk available. Now, the question we ask our clients is, what did you do in April of this year? When things went down, did you panic sell? And if so, then you're probably in too risky of a portfolio or position and need to look at diversification and going down the scale on the risk tolerance side of things. Um, if you panicked, then there's nothing wrong with it. It's just you might be in too aggressive of a holdings.
Nice. And what we're talking about, if you didn't panic, maybe you could take on a little bit more risk if you're really not paying attention so much to the day-to-day fluctuations of the markets. As we're wrapping up, we don't have any other questions. That's awesome. Gentlemen, come back in. We're happy to conclude the 101 series. Smiling Face Wally, Smiling Face Joel, Smiling Face Trevor. Have a terrific day. Enjoy the afternoon. And hopefully, if you're watching this on video, you're enjoying the wisdom of 50 plus years of collected investment wisdom. Have a great day. Pause my recording.